Welcome to the world of nonprofit accounting. If you're involved with a nonprofit organization or simply curious about how these impactful groups manage their finances, you've come to the right place. This guide will be your roadmap to understanding the fundamentals of nonprofit accounting. We'll break down complex concepts into manageable steps using straightforward language and practical examples. No prior accounting experience is required. We'll cover everything from the unique ways nonprofits generate revenue to the specialized financial statements they use. Let's get started. Before we dive into the specifics, it's important to understand what makes nonprofit accounting unique. Unlike traditional businesses driven by profit, nonprofits are all about mission fulfillment. Their primary goal isn't to generate wealth for shareholders, but rather to make a positive impact on the community or cause they serve. Nonprofit accounting is designed to prioritize accountability and transparency, ensuring that every dollar entrusted to the organization is used effectively and ethically to advance its mission. In the upcoming sections, we'll delve deeper into the key principles and practices that make nonprofit accounting distinct. Nonprofit accounting, at its core, is a specialized branch of accounting tailored to the unique needs and goals of nonprofit organizations. Unlike businesses driven by profit maximization, nonprofits prioritize their mission, the very reason they exist. Nonprofit accounting focuses on tracking, managing, and reporting on the financial resources entrusted to the organization to fulfill this mission. It provides a framework for ensuring that every dollar donated, granted, or earned through activities is used responsibly and effectively to advance the organization's goals. The goal is to demonstrate a clear link between financial resources and the impact they create. Transparency and accountability are paramount in nonprofit accounting. Since nonprofits rely heavily on public trust and support, it's crucial for them to demonstrate how they manage their finances responsibly and ethically. This involves providing clear, accurate, and timely financial information to stakeholders, including donors, grant makers, board members, and the public. Donors want to know that their contributions are being used for their intended purpose and are making a real difference. To maintain this transparency, nonprofits adhere to specific accounting standards and regulations, often stricter than those governing for-profit entities. By openly communicating their financial position, activities, and the impact they're creating, nonprofits build trust and credibility within their communities and the wider public. While traditional businesses measure success primarily through profitability, nonprofits focus on measuring their impact, the positive change they create in the world. Nonprofit accounting plays a vital role in this process by providing the financial data needed to assess the effectiveness and efficiency of programs and initiatives. For example, a nonprofit organization providing job training programs might track not only the cost of running the program, but also the number of participants who successfully secured employment after completing the training. By analyzing these metrics, the organization can demonstrate the value and impact of its work to funders and supporters. By tracking and reporting on their impact, nonprofits demonstrate their commitment to making a meaningful difference and using funds responsibly to achieve their mission. In the world of nonprofit accounting, we encounter a unique method called fund accounting. Fund accounting is all about accountability and transparency, ensuring that every dollar received is used for its intended purpose. Imagine a nonprofit organization that receives a large donation earmarked specifically for building a new community center. With fund accounting, this donation wouldn't simply go into a general pool of money. Instead, it would be placed in a separate fund designated solely for the community center project. This segregation of funds is crucial because it prevents the accidental or inappropriate use of restricted donations. Think of fund accounting as managing a series of separate buckets, each representing a different funding source or purpose. You might have a bucket for unrestricted donations, which the organization can use for any of its operational needs. There might be another bucket for a specific government grant, with stringent guidelines on how the money can be spent. Then, you could have a bucket for a fundraising event, where the proceeds are intended for a particular program or initiative. Each bucket represents a separate financial entity, with its own set of rules and restrictions. This approach makes it easy to track income and expenses related to each fund, ensuring that funds are used in alignment with donor wishes and grant requirements. This not only ensures compliance with the grant requirements, but also provides valuable data for evaluating the program's effectiveness and reporting back to the grantor. Fund accounting goes beyond simply complying with regulations. It's about maintaining the integrity of the organization and building trust with stakeholders. By demonstrating responsible stewardship of funds, nonprofits inspire confidence in their operations and their ability to fulfill their mission. Donors are more likely to give generously when they trust that their contributions will be used wisely and ethically. Grant makers are more likely to award funding to organizations with a proven track record of financial accountability. In essence, fund accounting is the bedrock of financial accountability and transparency in the nonprofit sector. By embracing this approach, nonprofits can focus on what matters most, making a positive difference in the world. Unlike traditional businesses that generate revenue through the sale of goods or services, nonprofit organizations rely on a diverse array of funding sources to fuel their missions. These revenue streams are often a mix of earned income, contributed income, and in some cases, even investment earnings. One of the most well-known sources is contributed income, which includes individual donations, grants from foundations and corporations, and bequests. Another important source is earned income, which comes from activities related to the nonprofit's mission. For example, an arts organization might generate earned income through ticket sales for performances or workshops. A key aspect of managing nonprofit revenue involves understanding and respecting donor restrictions. Not all funding comes with the same level of flexibility. Some donations or grants might be designated for a specific purpose, such as funding a particular program, supporting a capital campaign, or covering administrative costs. Restricted funds, as they are called, come with an obligation to use the money only as the donor intended. Failing to comply with donor restrictions can have serious consequences, damaging the nonprofit's reputation, jeopardizing future funding opportunities, and even putting their tax-exempt status at risk. In the realm of nonprofit finance, not all funds are created equal. One of the fundamental distinctions is between restricted and unrestricted funds. As the name suggests, restricted funds come with strings attached. These are donations or grants that have been designated by the donor or grantor for a particular purpose, limiting how the nonprofit can use the money. Think of it like this. A generous donor is passionate about supporting a nonprofit's after-school literacy program. These funds would be classified as restricted because the donor has placed limitations on how they can be used. On the other hand, unrestricted funds are the lifeblood of a nonprofit's operational flexibility. These funds come with no strings attached, allowing the organization to use them for any purpose deemed necessary or beneficial to its overall mission. Unrestricted donations are incredibly valuable because they provide nonprofits with the financial agility to respond to emerging needs, seize unexpected opportunities, and cover essential operating expenses. The flexibility afforded by unrestricted funds is essential for maintaining a strong financial foundation and ensuring the long-term sustainability of the organization. However, it's important to note that even though unrestricted funds offer greater flexibility, nonprofits are still accountable for using them responsibly and ethically. Just like a ship needs a map and compass to navigate the seas, nonprofits rely on financial statements to navigate the complex world of finances. These statements provide a clear and structured view of the organization's financial health, performance, and cash flow, helping stakeholders understand how resources are being managed and the impact being achieved. In the realm of nonprofit accounting, three key financial statements take center stage: the Statement of Financial Position, the Statement of Activities, and the Statement of Cash Flows. Each statement offers a unique perspective on the organization's finances, and together they paint a comprehensive picture of its overall financial well-being. The Statement of Financial Position, also known as the balance sheet, provides a snapshot of the nonprofit's financial standing at a specific point in time, typically the end of the fiscal year. It presents a summary of the nonprofit's assets, liabilities, and net assets, giving stakeholders a clear view of its financial strength and stability. Assets represent what the nonprofit owns, including cash on hand, investments, property, equipment, and even intangible assets like trademarks or copyrights. Liabilities, on the other hand, represent what the nonprofit owes to others, such as accounts payable, salaries payable, loans, or deferred revenue. The difference between assets and liabilities represents the organization's net assets, also known as its equity. The Statement of Activities, often referred to as the income statement, tracks the nonprofit's financial performance over a period of time, typically a fiscal year. This statement tells the story of the nonprofit's revenue generation and expense management, revealing whether it's operating at a surplus or a deficit. It provides valuable insights into the organization's ability to sustain its operations and fulfill its mission. The Statement of Activities presents revenue from various sources, including donations, grants, program service fees, and investment income. On the expense side, it categorizes expenses based on their purpose, such as program services, management and general expenses, and fundraising costs. Let's delve deeper into the Statement of Financial Position, often referred to as the balance sheet. This statement provides a snapshot of the nonprofit's financial health at a specific point in time, typically the end of its fiscal year. On one side of the balance sheet, we have assets, what the nonprofit owns. These can be tangible items like cash in the bank, investments in stocks or bonds, property, equipment, and even artwork or historical artifacts. On the other side of the balance sheet, we find liabilities, what the nonprofit owes to others. The difference between assets and liabilities represents the organization's net assets, also known as its equity. Section 2. Deciphering the Statement of Activities, revenue, expenses, and more. The Statement of Activities provides insights into revenue, expenses, and the nonprofit's financial performance. It begins with a summary of revenue from various sources. Revenue can come from donations, grants, and earned income. Next, expenses are categorized by purpose and function. Common categories include program services, management, and fundraising costs. The difference between revenue and expenses reveals net income or loss. A positive net income indicates a surplus. A negative net income signifies a deficit. Section 3. Navigating the Statement of Cash Flows, tracking the flow. Let's turn our attention to the Statement of Cash Flows, tracking cash movement into and out of the nonprofit. It provides a crucial perspective on liquidity, the ability to meet short-term obligations. Cash flows are categorized into operating, investing, and financing activities. Operating activities include cash from donations and payments for salaries and supplies. Investing activities involve buying and selling long-term assets. Financing activities include borrowing, repaying debt, and receiving long-term contributions. Section 4. Putting it all together. Understanding the interplay. These three key financial statements, the Statement of Financial Position, the Statement of Activities, and the Statement of Cash Flows, work in concert to provide a comprehensive view of a nonprofit's financial health and performance. Understanding their individual roles and how they relate to one another is essential for making informed decisions and ensuring the organization's long-term sustainability. The Statement of Financial Position provides a snapshot of the nonprofit's assets, liabilities, and net assets at a specific point in time, while the Statement of Activities tracks its revenue and expenses over a period, revealing its financial performance. The statement of cash flows complements these statements by tracking the movement of cash, highlighting the organization's liquidity and its ability to meet financial obligations. By analyzing these statements together, stakeholders can gain a deeper understanding of the nonprofit's financial stability, its effectiveness in utilizing resources, and its ability to generate sufficient cash flow to support its mission. In nonprofit fundraising, donor trust is paramount. Donor restrictions dictate how funds can be used. Nonprofits must honor these restrictions. Failure to comply can erode trust and jeopardize funding. To ensure compliance with donor restrictions and maintain transparency, nonprofits need robust tracking and reporting systems. Document each donation's nature, including restrictions, and establish separate accounts for restricted funds. Imagine a nonprofit receives a significant donation for early childhood education. These funds are classified as restricted due to the specified use. Set up a separate account to track all income and expenses for the initiative. This approach demonstrates to the foundation that funds are used solely for the intended purpose. Section 1. A roadmap for impact, the power of planning. In the dynamic world of nonprofits, where resources are often limited and demands are high, effective budgeting is not just a financial exercise, it's a strategic imperative. A well-crafted budget serves as a roadmap, guiding the organization toward its mission goals, ensuring financial stability, and fostering accountability. Unlike for-profit businesses that primarily focus on maximizing profits, nonprofits prioritize mission impact. Their budgets therefore need to reflect this unique focus, aligning financial resources with programmatic goals and demonstrating how every dollar invested contributes to achieving the organization's mission. The budgeting process typically involves collaboration among various stakeholders, including program staff, development teams, finance personnel, and board members. This collaborative approach ensures that the budget reflects a shared understanding of the organization's priorities, resource constraints, and opportunities for growth. Section 2. Balancing the books, aligning resources with mission. Creating a nonprofit budget involves a careful balancing act. On one hand, nonprofits strive to be fiscally responsible, ensuring that expenses are kept in check and resources are used efficiently. On the other hand, they also need to invest strategically in programs, staffing, and infrastructure to effectively deliver on their mission and achieve meaningful impact. The budgeting process typically begins with a revenue forecast, projecting the anticipated income from various sources, such as donations, grants, program service fees, and investment earnings. This forecast should be based on historical data, current fundraising efforts, and any anticipated changes in funding patterns. Once the revenue projections are established, the next step is to develop expense budgets for each department or program area. This involves carefully considering the resources required to deliver programs and services, including staffing costs, program supplies, marketing and outreach expenses, and administrative overhead. A key aspect of nonprofit budgeting is distinguishing between restricted and unrestricted funds. Section 1. The Foundation for Impact Mastering Nonprofit Accounting. Congratulations on completing this journey through the fundamental concepts of nonprofit accounting. You've gained valuable insights into the unique financial landscape of mission-driven organizations, equipping yourself with the knowledge to make informed decisions and contribute to your organization's long-term sustainability. Remember, nonprofit accounting is not just about crunching numbers. It's about ensuring that every dollar entrusted to the organization is used responsibly and effectively to create a positive impact. By embracing the principles of transparency, accountability, and stewardship, you can help your nonprofit thrive and fulfill its mission. We explored the importance of fund accounting, understanding the crucial distinction between restricted and unrestricted funds, and how these funds must be meticulously tracked and managed to honor donor intent and comply with regulations. You learned about the 3 key financial statements: the statement of financial position, the statement of activities, and the statement of cash flows, and how these statements work together to provide a comprehensive view of a nonprofit's financial health, performance, and liquidity. Section 2. your journey to financial stewardship, resources, and next steps. Learning is an ongoing process. Explore online courses, workshops, and webinars. Reputable organizations like the National Council of Nonprofits, Foundation Center, or GuideStar offer valuable resources. Networking with other nonprofit professionals can be incredibly valuable. Seek guidance from experienced mentors or financial advisors. Their expertise can help ensure your organization's long-term financial sustainability.